Hey everybody, this is Tech Talk Tuesday, and I'm David Blake. If this is your first time attending, I want to thank you for joining us. We usually go about 20-25 minutes talking about charts and sectors, and then at the end we'll open it up to questions from you, and they can be about anything from individual stocks, other markets, sectors, different industries, whatever's on your mind, we'll try to cover. Today I want to show you some chart patterns that we're looking at on the broader market. Some different price levels that could point to a continuation of the downtrend, and or perhaps maybe signal that a bottom is already in. Then I'm going to pull out some old charts, and we're going to look at chart patterns from the past that have shown us that a bottom is in, and we'll get started with that right now. Okay, last week we had Fed Chairman Janet Yellen kind of threw us a curveball at the conclusion of the September FOMC meeting. And at first, market participants liked it. Dow rallied about 175 points. And then we got up to some resistance areas with the different indexes, and the traders kind of sold the news. The Dow clipped off about 350 points to the downside going into the weekend over the last 2 days. That move where she introduced a third mandate before raising interest rates kind of rather than solving some questions and bringing more certainty into the market, that kind of it kind of brought more uncertainty than what she'd imagined. That just happened before we were all set with the jobs data, we were set on the inflation data, and now she's going to be considering what's going on around the world. Yesterday we had a nice little rally, maybe another relief rally after being down 350 points, but today we're kind of rolling over. And we actually have taken out some of the price patterns and price targets that I had set up from last night. The first thing we're going to look at is a chart of the Dow Jones. If I can just get, there we go. Okay. What you're going to see here, Thursday's rally stopped right about where we talked about in the previous meetings where resistance would come in. That's right over here about this 16.9 area, 16.925, and that was actually the 50% retracement from the summer high back to the low over here, this 24th low. And when the Dow Jones failed to get through that resistance area, it represented a good place to take some money off the table. Now the lines over here that you're looking at, I drew in. This is a bearish chart pattern. It's called a rising wedge. And what happens with a rising wedge, it's bearish because it shows the bulls are unable to push the index any higher on subsequent rallies, and buyers start selling at the highs over there, and the market will come down. Now, what I wanted to show from last night when I was doing these charts, I was considering that if the Dow Jones is going to slide back below this 16.4 area, it's going to break below this rising wedge pattern. If it picks it up, if we can actually do a measure, if it gets down here around 16,250, right around where we are right now, because we're down 260 points as we speak, that's going to get a targeted move back down to the lows from August. So that low is 15,370. Traders will watch that. If that's able to hold and we can bounce off that level, that would probably be the line in the sand. Now the next chart we're going to look at, very similar, and this shows the S&P 500. Again, we actually went through the 50% retracement over here right around 2,000 on Thursday afternoon, but it reversed course intraday, came back down into the rising wedge pattern. And I was in my report last night, I was looking at if we see the S&P 500 fall below about 1950. It's probably going to signal that we're going to go down here and at least test these lows again. Currently, we're at 1934, down about 1.65%. I think you're going. That's probably continuing. You're showing that we're going to go lower. Here's the Nasdaq. It looks similar to. Here's the rising wedge. It broke about above it, came up here, broke above the 50-day, ran right into the resistance of the 200-day moving average, and now we're back in here. This area where it breaks out of the rising wedge is right around 4,800, and we're about 70 points below that right now. We're at 47.32, so we're down in here, and that's probably signaling a another retest down here, probably in the 40, anywhere between 4,300 and 4,400. So the first three charts we have broken out today to the downside. But what I also want to do is look at a couple other charts. And the reason, what we're trying to accomplish today is to see if we can find whether, maybe some different patterns that are going to show that we're near a bottom. Now, this is the Dow Jones Transportation Index. I still believe that this is the index that will probably lead the broader market higher. It led the market lower last year. It peaked, I think, last December. Since we sold off over here in August, the index has risen about 9.7% from the bottom. As you can see on this line over here, it's not really a rising wedge, but if we break below 8,000, that's going to be another bearish indication that the transports are probably also going to go lower. We're right now at about 79.19, so we've broken that. We're down 2.25% right now. So we're down over here. Again, breaking that, looks like it's going to go down and retest that August low on that. Another one I wanted to look at, and this is the Philadelphia Semiconductor Index. It looks very similar to the overall NASDAQ with a rising wedge. But as you see here, it failed recently at the 50-day moving average. This was quite a bounce off of the bottom. The stocks or the Philly Index rallied 16.5% from the bottom over here to the 650 area. Never quite made it back to the 50% retracement area, which is kind of bearish, and it's falling back down here today. We're down a couple percent today with that. So the fact that we broke below this 62.8% retracement is another bearish sign that usually when you break below this, you're going to go back down and test these lows also. Okay, so the next one we're going to look at briefly is the symbol on this is an ETF. It's DBC. And this is the Power Shares Commodity Index. It's heavily on crude oil, heating oil, gasoline, gold, silver, copper, corn, wheat, sugar. As you can see over here, this has been in a downtrend. We can't even get above the 50% to the 50-day moving average. Again, it's bearish. However, we are seeing a little bit of a sideways motion over here over the last week or two. Part of that is the volatility of crude oil, but that is a sign that you want to look at. If we break below this line over here that I've drawn, I can't see the what the number is, but that would be a bearish inclination for that. Okay, so why do we look at the last few charts rather than the broader markets? When you're looking to find whether the market has bottomed or not, what you want to try to do is you're looking at other charts outside indexes that might be hinting that we've already put in a bottom or by themselves. Okay, if you look at one chart, it's never going to tell you whether the broader market's bottom. But if you have a broken chart like we have now, you want to find something in the market that's actually working. If you look at a variety of indexes, as well as some internal breadth indicators, which we're going to look at here in a minute, you can get signs of positive divergence that will tell you that the bottom may be in. Okay, right now the Dow Jones Transportation Index was up until Friday and was showing positive divergence until today. Again, it just broke down below the support levels, which is a negative. The commodity index may be showing some positive divergence in the sideways motion that we've had recently, but we have to see how some of these charts perform on a down day. As I wrote this last night, we're getting that today. Right now, I want to look at this some of the internal breadth indicators, which were also showing positive divergence. And this is a good chart to look at. It's found on the home page of Market at a Glance on Market Edge. But you can see finally, after all this time from last May, making lower highs and lower lows, we came up here, had a little bounce off of this low from August. We made a higher low here. We broke out into another higher high. But today, with a couple of bad days, is this going to come down here and take this out again or not? If we can come down here and it takes maybe sticks around above 315 or so and then starts back up, that shows positive divergence. We're going to see, does the sell-off cause us to make a lower low, or If it did, that negates the positive divergence. But if the market sells off and we have a 200 or 300 point down day, like the last two charts, are we still making a higher low? If that's the case, then we have something that we can at least count on that would be an inclination that maybe the market has put in bottom already, and we may not go all the way down to those levels. Now here's the NASDAQ advanced decline. Again, we're seeing some positive divergence in the advanced decline line. This is showing that people are buying stocks in here. There's more advancing issues than declining issues. Okay, if we have a bad day like today, the sell-off caused the chart to make a lower low. That's what we'll have to look at here in the next day or so. If it did, that'll negate this positive divergence. But if the market sells off and these last two charts are still making higher lows, then again, we have something. Okay, these last two charts go along with what I mentioned earlier, where we're looking at several different areas of the market and different segments of the market where we're seeing some positive divergence that can show that we may not quite go down and test the previous lows. Now, there's other indicators that I want to look at to see whether we're at a going to go lower, or perhaps we're seeing some positive divergence. Now, this one is a chart of margin debt, and over the last few years, you can see a steady rise in the amount of margin that investors were taking on. And this shows that investors are feeling pretty good about the stocks, and they're going to borrow money to buy stocks. And when that market looks shaky, they're going to cash in some of the chips and take some of the margin off. Unfortunately, this is kind of a lagging indicator because it's not reported for it's probably at least a month behind before you see it. So if the market's down, margin debt's fallen for several months, you want to see an uptick in this, which shows that people are talking with their money, and they're actually going to borrow some money because they think that the market's probably bottomed, and we might be able to work our way higher. Okay, another lagging indicator that we follow in the Market Edge weekly market letter, and that's short interest. This is also reported late, but it shows when people stop shorting the market, it's near the bottom. Last week, unfortunately, or actually for the end of August, NYSE short interest rose about 4.8%, which means that people still feel comfortable that the market's going to go lower. NASDAQ rose about 3.5%. That is not at an extreme level. When you see a jump up here where maybe you might see the short interest jump about 8 or 9%, something like that would also be a contrarian indicator because everybody's just shorting anything that moves. That's usually a time when you could actually go against the crowd and move in. Okay, we're going to wrap it up here. But I do want to show you a couple more chart patterns that I want you to be familiar with going forward. And what these are going to do is show you some bottoming patterns that you can look at if you see some pullbacks. Now, this is the NASDAQ composite. This is from about March 2010 to November 2010. And what this is a reverse head and shoulders pattern. There you come down, you make a low. This would be a shoulder. You go up a little bit, then you come back down. This would be the head. You have a little bit of rally, bounce off of that, and you come down here and you have the right shoulder. Now, what you want to look for on this is you draw a line across where the neckline is from the head to the shoulders. And what you're going to do is when it breaks above this, that means that the bottom is in. You're going to get a nice rally. Right over here is where we broke actually above the 200-day, cleared the neckline, and the NASDAQ began to rally after this 2009 area. And it started actually at the beginning of this bull market that we're in right now. Okay, here's another bottoming pattern I want to show you. This has a couple of different patterns. First off, right over here, we have a double bottom. This means when the market had a nice rise, we came down, we hit a level here, we bounced off it, came up, made a little bit new high, and then we came down. But what happens? We came right almost to the exact same number, and once that held, you had a rally off of that, and that's called a double bottom. Now, if we sell off over here in the broader market, and we come down and we test these lows from August, that's going to represent a double bottom pattern again, and you can expect to see a bounce off of that area. Okay, now you can have more than a double bottom. Over here back in 2012 or 2014, we actually came down and tested an area 1, 2, 3, almost 4 times. And actually, if after you've had a double bottom or triple bottom, if this last one comes down and doesn't quite make it down to the bottom, that means investors are getting a little bit more excited that the bottom is in, and they're going to start buying before we actually come down and test this. Now, if you started buying here and it came down and broke this, of course, all bets are off, and you're going to have a failed pattern, and you're going to go lower. Okay, so what we were talking about here. Okay, here's another one. This is the this shows a couple of different things here. This is the S&P 500, and this shows you another bottoming pattern, which is a selling climax. After a period of working your way lower, kind of almost like what we had on September 4th. You'd want to see this where we open up, we head down, we could head down 4 or 5% possibly, but buyers come in, and by the end of the day, this is a candlestick chart, you actually will end up either even or actually positive for the day. This means that the investors have decided, okay, that's the bottom, we're out of the woods, let's get going. And they're going to play that, and usually we'll get a nice rally off of that. Okay, and not only did we get a little rally off that, in this chart pattern, we actually came down and we got another reverse head and shoulders, and then we came up here, here's the break, here's the neckline, and we started to take off over here again. So these are patterns that if you put them in your arsenal, I think it's good to understand these things because it's going to tell you, it's going to help you see by the chart pattern alone that the bottom is probably in, and that we're going to work our way higher. Okay, so have we seen the bottom this go around? After looking at these charts, I think you're going to probably conclude that it may be too soon to tell. Today's action is bearish. The longer-term indicators are still bearish. A few of the charts were showing some positive divergence, the AD lines. We want to look at those charts again after we have a big down day like today to see how much deterioration we had in these different charts. However, if we have the big down day and we see the lows from the AD lines we're able to hold, that they're still intact, that's positive divergence, and that's good. If we see the net Dow Jones Transportation Index, which was showing positive divergence again until now, we want to see if that can lead the broader market. Okay, we want to see the three majors. It's the Dow Jones, S&P 500, NASDAQ. I wrote this last night. I wanted to see if they were going to break below their rising wedges, which they did today. That's a sign that it's going to negate some of the positive divergence that we saw earlier. So the conclusion on my end is I think we still have some work to do on the downside. I really do think we do, but for the first time in several weeks, some of the charts were showing signs of positive divergence, and that, to me, indicates that the selling will probably stop down here at the August 24th lows. I'm staying cautious, but I do see that I don't want to put too much money to work at this point. Until we see a clean break to the upside of some of these highs from early September, I think we got to be on hold, or maybe if we can have some rallies, it'll take us up over the up over to the 50% retracement. Usually I go over some of the different sectors, but today I didn't want to do that because I knew this was going to take a little bit of time. But the materials sector, the energy sector, the financial sector, and the industrial sector all had gap breakdowns from their rising wedges, which means I would still stay clear of those. You might get a bounce in oil. I would use those bounces to for short-term trades only. The XLK, which is the technology sector, was a little bit weaker today. Areas that you do want to nibble away at when you start to see that the market starting to move a little higher, I would look at the consumer staples. We talked about that, like stocks like Kimberly-Clark, Colgate-Palmolive, some of the companies that get most of their revenues and income state-wise, not internationally. XLU, the utility sector, has a nice-looking chart. And we can look at some of these charts later on when you have a chance. XLV, the healthcare sector, it was looking good until yesterday and today. It's had a little bit of sell-off, especially in the biotechs. And lastly, XLY consumer discretionary. That's your retail, your home builders, footwear, stocks like that, Nike, Home Depot, Lowe's, Pulte Homes. They all look pretty good. Those are the areas that I would look for once we think a bottom is in. We do have some questions here on the chat line. I'm going to open that up if you have some questions. Okay, what are your thoughts and patterns on Europe and the international markets? I haven't done a lot. Have they bottomed? I think some of the international markets are going to, I think we're all kind of looking at China to see what's going to happen over there. It's going to need to stabilize. Obviously, their market coming down like this was enough to put the Fed on hold for a little bit. So whatever happens in China and some of the emerging markets is definitely going to have a carryover effect to our market. The wild swings in that, it's swinging 5-6% a day. So I don't think a bottom is in over there yet. Only time will tell. I don't have any charts on that right now to look at, but again, I'm concentrating right now on whether or not we're going to make a bottom over here. Any other questions on anything? Didn't want to show you over here on some of these sectors. I'll look at this real briefly that I was talking about. So you can see some markdowns here. That's not shared? Okay. I can't share these charts, but so I'll have to put them in next week. But I was going to show you some of the different sectors where you can see they're starting to break down. Okay, if we don't have any more questions, the link will be on later on. That way you can write down some of the, look at some of these charts to see where the rising wedge, where we fell below it today. And the link will be on the, if you log into your Market Edge website, and on the markets page, you can click on that link. It should be up here within about an hour, and then you can write down some of the numbers that we want to watch. Other than that, I'll see you next week. Thanks for joining me, and have a good week.